Welcome back to Not Financial Advice. Today, we're going to be taking a look at TJ Maxx, a company you're probably familiar with, but if you're not, you should be. And I'm going to show you why. So, before we get started, I'll ask you to like and subscribe to this video and channel and turn the bell on so you can be notified when I post videos in the future. So, TJ Maxx is a American multinational discount retailer, primarily of clothing, but also of housewares and other products. They're a company that essentially buys overstocked items when other companies order too much, or they will buy winter clothes in the middle of summer. Store them and then sell them at the appropriate time, but they're selling clothes essentially at a 20 to 60% discount from their competitors. And so that's something that obviously gives them a huge competitive advantage. Today, the stock price is trading for $88. And we're on Qualtrim as always, software that I pay for to look at stocks, but not a company I'm affiliated with. So I'll leave a link to Qualtrim in the description below. So the price of the stock is $88. Let's take a look at the price performance of the stock over the years. So this would be one that could be described easily as a power stock. Um, Looking at a trend line, obviously, a clothing retailer, I'm sure that they're doing more online than they were in 2010. But I do believe the majority of their revenue is coming from their physical locations. And so they haven't reinvented the wheel, but looking at this price chart, although this is a stock that, seems to be very powerful, it might be slightly overvalued. So this is the price action of the stock. Let's look at some of the metrics and performance of the company so we can get a better idea of what the company is worth, just as opposed to what the stock price currently shows, as those things can be not the same. So TJ Maxx, they're a $100 billion market cap company. So they're a quite large cap company. They'd probably be described as a large cap blend company, neither a growth company nor a value company, just a really strong large cap company with a forward PE of 22.5. Okay. Additionally, let's look over at the stock-based compensation adjusted free cash flow yield. So that's $4 or 4.4%. What that means, folks, is that at the end of the day, after they process $100, at the end of the day, $4.40 are profits that can be distributed to shareholders. So a really nice free cash flow margin. Their cash and debt position is really strong. So they have $4.5 billion of cash and only $1.25 billion in debt. So um, their cash position is 3 or 4 times heavier than their debt position, which is really good. Looking at the dividend on the stock, this looks pretty attractive to me. Currently has a market matching dividend of about 1.53%, but only at a 37% payout ratio. So that's an indication that this is a stock where dividend growth, will be in its future. So we know the stock's trading for $88. Let's take a look at the revenue, and this is going to be really important. So the revenue looks great up and to the right. So clothing is considered to be consumer discretionary or consumer cyclical. It's not considered to be the same thing as, groceries. It's considered to be something that's discretionary. Um, but I received a call from a friend of mine, a hardworking mom, who wanted to show off, um, a whole winter wardrobe for her son who's 10 years old. And so she showed off 2 or 3 bags worth of clothing on a video chat, matching name brand, sweatsuit sets, as well as, tops and socks and thermal underwear, things of that nature. And I guess, she was showing me how great the prices were. And I said, wow, you got a whole winter wardrobe for, like $200. She said, no, it was a lot less than that. It was closer to 100. So 3 full bags of clothes for about $100. Um, Being a discount retailer, I think that although this is considered a discretionary or a cyclical stock, I think it has a lot of really defensive trends. Moms are always going to need to buy affordable, high quality clothing for their children for school. It's not going to stop. And so, we say that this is cyclical, but let's look at the tech crash of the stock market. 1999, they did $7.9 billion in revenue. This tech stock crash happened, and they went up to $8.8 billion in revenue. So we know the financial and banking crisis started from about 2007, 2008, and lasted through about 2011. So in 2007, they did $17.4 billion in revenue. So they had almost 2x their revenue since the market had problems with technology stocks in 2000. They 2x their revenue at the start of the great financial crisis and recession. And in 2007, they did $17.4 billion in revenue. As the economy and everything was getting worse, they had increased growth. In the worst of it, they still had increased growth. And as we were coming out of it, their revenue continued to grow. So the great financial crisis and great recession, they went from $17.4 billion in revenue to $21.9 billion revenue in a recession. All right. And so the best time to have bought this would have been when people weren't buying clothes to go outside, which would have been during COVID. So they had a big drop off there. Obviously, that would have been a great buying opportunity. But they've come back bigger and better and stronger than ever before. And even as the markets had problems in 2022, they did a lot better than they did in the years ending in 2019 and 2020. Great, 2, 3, 4 year stack, and this year revenue of $50 billion. So great revenue on this company. For our valuation, we're going to be looking at this number. A 10-year growth rate of 6.8% is pretty solid. So let's look at their free cash flow as well on an annual basis. We can see that this is since since their cash flow may have been affected during the financial crisis to an extent. Um, but at the peak of it, they did better. And as they were coming out of it, their cash flows continue to be up and to the right, up and to the right. And, you can see here they had higher cash flow. They had higher cash flow in um, the fiscal year that was surrounding their drop in revenue with COVID. So that, would be possibly buying less clothing because less clothing was being sold. So their cash flow position actually improved as they were doing less revenue. But the cash flow looks pretty fantastic up and to the right without a huge amount of dilution. They're not issuing a lot of stock to the executives that are diluting shareholders. So that's really great. Let's take a look at some other things that matter. We'll take a look at the earnings per share. This is often, the way Wall Street prices stocks. And so that picture looks really great. Let's take a look at their dividends. So a continual track record of growing dividends with a low payout ratio. That looks really great as well. Let's take a look at other things that matter. So this is a company that buys back shares. Even though their price has always gone up, they've continued to buy back shares. It's overall, it's a good thing. So additionally, let's take a look at some of their ratios. Let's look at the bottom line of their profit margin. So around 7% is really, really good for their bottom line of their profit margin, especially for a retailer. So at the end of the day, they're spending 93 cents and they get 7 cents in profit at the end of the day. A little bit confusing, but I think you get the picture. So let's take a look at their return on capital employed. It is really, 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 really high. This deserves a little bit of a premium. They're trading at that 22% PE ratio. So, they're low on certainty, they're high returns on capital, they're buying back shares, they have a solid and growing dividend, really great cash flows and earning per share. This is definitely, I would say, a wide moat company or a narrow moat company, but a company nonetheless with a moat that you know trades trades at a multiple and is at a higher multiple, and it's deserving of that. And so it always lives around this 20 PE ratio. It does, in fact, appear. So let's see here what insiders are doing. So some insiders are selling shares because they want to buy yachts. Um, haven't had any buys recently. Doesn't necessarily throw me off too much, but let's take a look at what TJ Maxx is and what it's like if you've never been to one. So as you're taking in these images, these are just images uploaded by shoppers from my local TJ Maxx, and you can get a sense, a pretty Spartan store layout, not overly fancy. No walls separating departments. And the way that these stores are set up, there's a little bit of a Costco effect going on here, which I've detected that is going to be important for us to understand about the way that TJ Maxx makes money. So that's the name of their company, the name of their stock, but they also own Marshalls. My understanding, it's a slightly higher end version of TJ Maxx. Home Goods uh, is probably a more middle class version of Williams Sonoma, so probably kitchenware and things of that nature. No idea what Sierra, Winners, or HomeSense is. HomeSense might be a little bit of a higher brand of home homeware goods, and then I think this is their international brand. So they have several brands under TJ Maxx, but let's get a sense of how much of their revenue is domestic versus international. So they have 13.5% of their revenue is international. A lot of that is coming from Canada. And my understanding is they're on 3 continents, obviously North America, not sure where else, probably Europe, as well as somewhere else. But majority of their clothing is from clothing and footwear, home fashion 38%, and then jewelry and accessories 15%. So that's interesting. So how does TJ Maxx do it? This part is really important, folks. At this point, I'll ask you to like and subscribe to the video if you haven't already. But TJ Maxx, as a leading off-price realtor of retailer of apparel and home fashions in the US and worldwide, TJ Maxx delivers great value on an ever-changing selection of high-quality, fashionable, brand name, and designer merchandises at prices generally 20 to 60% below full-price retailers. Um, and so that's sort of what their pricing looks like. And so they have buyers, and the buyers are optimistic, probably, as well as entrepreneurial and opportunistic. When a designer or manufacturer overproduces or other stores overbuy, we swoop in, negotiate the lowest prices possible, and pass on the savings. Never the same selection. So I mentioned Costco, and so this is something that you can do to make the consumer so much, quote unquote, addicted. So when you go to TJ Maxx on the first of a given month and then go back on the first of the next month, that inventory is going to be mixed up. With those low prices and ever changing inventory, that encourages shoppers to return more often. And so that's a really great thing that they do there. So, no one way we buy. We take advantage of a wide variety of opportunities, including department store cancellations, a manufacturer making up too much product, or a closeout deal when a vendor wants to clear merchandise at the end of a season, as we talked about earlier, as well as lots of other ways to bring our customers tremendous value. And then this is, again, the Costco factor here, operating our stores for amazing savings. So our stores and online websites are as flexible as we are. We have no walls between departments. We can easily expand and contract merchandise categories to respond to newest trends and market demand. Changing customer tastes, seasonal merchandise, or opportunistic buys. We love our bright modern stores, and our lean, no-frill ways of working helps us pass on these spectacular savings to our customers. So don't expect fancy extras in our stores, just amazing merchandise at fantastic prices. So now we've learned, quite a bit about TJ Maxx in this short period of time, and we're going to come back over here. Really all of these boxes, all these check marks are marked. And so it's currently trading for $88. It's gone up just while we've been recording this video. So now what we're going to do is we're going to take a look at what the fair value estimate of the price of the stock is. And so this data I've inputted from Qualtrim. An average of cash flow over the last 5 years is $2.8 billion a year in free cash flow. Cash position is 4.5 billion. Debt position is 1.2 billion. Shares outstanding 1,220. They're buying back shares. If you'll remember, their 10-year CAGR for revenue growth was something like 6.8%. So I've made some conservative assumptions here on the near-term growth, put it at 6%, dropping down to 5% and a 4% terminal multiple, because, as a defensive discount retailer, the economy or inflation probably grows at 3% a year. But there are some things that make this a pretty resilient business. So I've added a larger terminal multiple. And in this case, because of their performance during recession, because of their strong cash position, because of the defensive nature of this company, because of their diversification across brands, international exposure, because of, again, the dividend, the safe payout ratio, um, the the way in which the stores are operated, I don't see a huge amount of risk on this company. So I've put a lower discount rate. 5% is what you can get from a treasury, 2.5% for equity risk premium. Current price was around $88. Fair value is around $80. So it's trading a little bit richly right now, but again, as a power stock, this is one that's going to continue to trade at and above its intrinsic value. So this is not financial advice. I hope you enjoyed this presentation. If you did, like, subscribe, share with a friend, turn the bell post notifications on, and I will see you in the next one.